I did not project the kind of significant increases we would see in freight and transportation costs and all-time record fuel and diesel costs. Now we project that's going to hit us
about $1 billion of incremental costs
in this fiscal year. So a significant increase that we didn't anticipate. We saw great strength in
food and beverage and household essentials.
But we started to see some softening in some of the discretionary categories. TVs, kitchen appliances, bikes.
So kind of a mixed quarter here with Walmart's
a large miss for profit.
The retailer reporting $1.30 adjusted compared to an expected $1.48 per share, increasing its sales and lowering profit expectations.
I got to get to the 32% growth in inventory year on year.
32% is a gigantic number.
It's crazy. I mean, that's like 8% would have been high, 15% would have been terrible.
32% is apocalyptic. Billions of dollars in inventory.
Gas prices are remaining elevated. I mean, we're above, what, $4 a gallon on average.
Typically, gas prices in the Walmart customer world is one of the most difficult things for them to absorb. We saw that a little bit in their food business. The food business was up, I think, low double digits. Customers traded out of wants and into needs.
Wants and into needs. Wants and into needs.
Why, hello. Here we are again, Sunday evening. We've got a lot of fun stuff to talk about today, so grab a beer or maybe a water if you prefer, or maybe you're like Elon and you prefer to have a little bit of the herbal remedy. Whatever your choice, sit back and let's just dive right into it, guys. First up, let's go over some previous week's headlines. The first thing I wanted to bring up is Biden's disinformation board was paused as Scary Poppins resigns. The Department of Homeland Security has paused its newly created Disinformation Governance Board after its head, Nina Jankowicz, was called out for being a Russiagate truther. Whoa, whoa,
take some
whoa.
And makes them sound precocious by saying them in Congress or a mainstream outlet. So disinformation's origins are slightly less atrocious.
Holy shit. I don't know if you guys saw that or that was just me. It's probably been haunting me since I was editing that clip 3 weeks ago. But either way, Nina, I'm sure your 3-week run was amazing. We wish you goodbye and rest in pieces to your disinfo board. Next up, Sri Lanka defaults on debt for first time as economic crisis deepens. Now, I don't know enough about this story. All I heard was they ran out of money to purchase fuel. So do we care about this so much at this point? Maybe not. But are we going to see more of this to come? And at some point, is there going to be a country that defaults that is important, that somebody major is holding on to that debt, and it's going to cause a big uproar? So just be mindful of that as we move forward into this unknown territory here. And now the reason for that lovely opening clip we had today. Walmart and Target just sounded the alarm about this problem for shoppers. So we've seen now the fuel costs have been hurting us dramatically. You know, obviously everybody's situation is different, but now the fuel costs are starting to affect these large, massive retailers. So on top of that, the inflationary pressures that we've had over the last number of months, maybe the last year, have been weighing on these companies as well. And as we kind of talked about previously, we've had a historic jump in consumer credit, and we've seen saving rates drop below, I think, back to around 2013 levels. So people are running out of their stimmy money. They don't have a lot of savings left, and they're jacking up their credit cards here, especially as we've talked about interest rates rising. Those interest rates are going to start to go up. This is not a good combination for this economy, guys. We are a consumer-driven economy, and there's no way that we can have a strong economy without a strong consumer. It's just complete bullshit from the media side to say that the consumer is doing great. You also saw the massive buildup in inventory on the Walmart side. So from the discretionary aspect, consumers are not purchasing those items. They're focusing on the needs of life. It's food, fuel, etc., right? On top of my whole theory is with the whole Russia-Ukraine issue, the rise in fertilizer costs, and then the limitation on foods and grains and oats and things like that, I don't think we've seen the end of this inflationary pressure on the needs of life. So as we go into the end of summer, into fall timeframe, I think those prices are going to continue to go up. Now you may see these discretionary items start to drop, and if you still got some cash, you're probably going to find some good deals as Walmart tries to get rid of a bunch of this inventory, right? But that's not going to weigh well on their earnings moving forward. So we got a lot of challenges ahead from the retail side of things. And we'll go over some charts too on top of that. Another retailer, Ross Stores, shares sink as lower income shoppers feel the squeeze of inflation. Now, I didn't dive into the earnings on this, but I will say, full disclosure, I took a short on this. I like the chart, and let me show you why. Looking at a weekly on the left and a daily time frame on the right side of Ross Stores, let's look at the first thing here. So options were pricing in a $6.90 move plus or minus going into the earnings week. And the first things I liked about this chart from a weekly time frame is you've got a potential head and shoulders playing out here. This is a very bearish pattern that, doesn't always play out the way that you would think, but this 85 mark is utilized as your neckline. The other thing I wanted to note is you had a series of higher highs on the price side of things, but you had a number of lower highs on the RSI side. So this is what we would call a bearish divergence forming. And that's going back over the last 3 or 4 years even. So it's surprising that this thing has even held up to this point. So your measured move on this head and shoulders pattern, if we take the peak of the head down to the neckline and we transpose that down, your target on this is around 36. Now, I don't think I'll be in it that long. I have a calendar put spread on this right now, but you can see we ran into some support maybe potentially down here around the 70 mark. That's likely why it kind of closed off here. But if we go back to the daily time frame, so this is your first deviation. So this is what was expected going into earnings, right? It didn't even reach the second deviation. It blew right through that in the after hours session. And then it opened up down here even below the third deviation. So this is your third deviation here around 70, 71-ish. And as we can see, it closed right around that third deviation. There was potential for it to get down to this fourth one even. And you'll see on the case of Walmart and Target, I don't know if one reached down there for sure, but we'll look at those charts coming up. But again, this was a nice short setup. And I think overall the retail sector is definitely going to continue to struggle here, as we'll get into a little bit here in the charts again some more. And Cisco stock plunges as company forecasts surprising revenue decline. I don't read into this one too much. Cisco's always been kind of a boring market mover, but the fact that it's down 14% is pretty significant, I would say. So what it says here on the key points, Cisco missed on the top line in the fiscal third quarter and issued a worse than expected revenue forecast for the current quarter. Analysts at Citigroup said last month that competitors are taking networking switch market share from Cisco. I would also probably attribute some of this to the inflationary and supply issues, on top of, again, we are a consumer-driven society, consumer-driven country, and if the consumer is doing bad, these companies are going to start to struggle. So they're going to start cutting costs at some point down the line. Now, I don't know if that starts with hiring freezes, laying people off, internal cost-cutting measures, things like that. But I wouldn't be surprised if some of that was playing into this as well. Now, from an earnings standpoint, it wasn't all bad. John Deere beats earnings estimates and raises guidance. The stock falls anyways. Guys, I'm not sure why this happens sometimes. Maybe it's just that the expectations are so high leading into that earnings report. In addition to maybe now the market isn't buying into their raising the guidance. Maybe they're expecting, if we are leading into a recession and possibly a depression at some point, that's going to start to affect even John Deere. So I'm not going to read into this too much. I don't trade it. I don't care about it as much, but it's just something to be aware of. And last on the headlines and earnings side, Home Depot stock jumps after big earnings beat surprise same-store sales growth. Why don't we just look at the chart so we can kind of get a better idea of what's happened here. Looking at a chart of Home Depot, the weekly on the left side, daily on the right, you can see, as we've talked about numerous times, it's been trading within this or around this broadening wedge. And prior to that, you can see that we broke out of it, kind of tried to get above it, finally broke out, retested it as support, had this huge massive run up going into the end of the year before it kind of crashed and fell back into this range. Now, they saying earnings were great, guidance was good, and the stock jumped. However, I would beg to differ. Here was the closing price from the previous week. So looking at it in relative terms, 420.61 was your top. It was down around 30% from the peak here, back in December, and the stock ended up closing down 3% on the week. So not anything too exciting. It closed within its risk range, which is as expected in a lot of these cases, especially in the case of Home Depot. But it was pricing in a $21.51 move. Here's your upper risk range. Here's your lower. Close right within that range. So the headline might say something, but the chart doesn't tell me a lot more beyond that. I'm personally not too excited about this stock until maybe even around this point, maybe 250, which potentially maybe you can get a bounce up to here. But I don't like this pattern playing out. Could it bounce, in the next couple weeks? Possibly, but I don't really trade Home Depot. There's nothing too exciting about this at this point for me to get interested in it. All right, let's go over some previous week's technical charts. Since we covered Home Depot and ROST stores, I won't cover that in this case, but we'll go over some of the other ones that reported last week. The first one was Take-Two Interactive, this gaming company. Had a nice move. Here was your expected range, $10.41 move plus or minus. Came up to the top side of this range, and as you can see, it tried to hold it. And like most cases, it failed to hold that, fell back within the side of this range. And again, not unexpected, as we've said many times, 68% of the time, you're closing inside of these ranges. So just based off of general statistics and data analysis. Walmart. So this is one that was really interesting, just like Target. These are going to be very similar. So Target's on the right side here. First deviation, expected move, $7.28. Opened up a little bit between the first and second deviation, fell through there. And then I believe this was when Target reported that it just fell right through its floor too. So interestingly enough, this was your second deviation, your third deviation. And this is a rare case. It actually went down to a fourth deviation to close the week. So a lot of delta hedging from the dealers on this side as they blew outside of this expected move on the options part. So similar to Target, again, first deviation, second deviation, and Target got even more annihilated as it opened up below its third deviation here and crushed down to this fourth deviation to close off the week. Very abysmal. I would call that a disaster from a retail standpoint. Decker Outdoor Brands, not a bad move. It was expecting $27.13 move. Broke up to the top side of this risk range. But again, it closed kind of right within the expected move here. So nothing too crazy to write home about. CSCO, we kind of mentioned this one in earnings. Expecting a $2.99 move. Here's your first deviation. It opened up below its second deviation. Didn't quite come down here and tap this third deviation and then close between the third and second. So again, clearly the earnings were poor enough to where it blew past through these deviations. And I'll be honest, I've watched CSCO over the years. For it to do this is a really big move. A lot of times it will just kind of flutter within the expected range, which is usually pretty tight like that. But this was significant. Kohl's also reported it was expecting an $8.32 move. You can see before earnings, it came down and tapped the low side of this. Maybe it was getting weighed on by some of the earnings up by Walmart and Target naturally, but then it got a nice bounce. So again, if you're trading these risk ranges outside of the events, you caught $40 and it moved all the way up to even 44, 45, 46. And honestly, you're never going to get the exact move all the way up to that point, but it doesn't surprise me that it came back up and tried to retest this gap down level and failed. So you had a nice move here if you decide to trade intraday. In a lot of cases, maybe you guys just don't do that, but for day traders, that's a decent move. John Deere, we kind of talked about this one too, just from an earnings standpoint. But again, expecting a $24.36 move. Here's your lower range. Here's your upper. It opened up right underneath that first deviation to the downside, tried to capture it here, failed, and then just continued on down. So I'm guessing, I don't have the actual level in here, but I'm guessing the second deviation is somewhere around this range. So came down to that second deviation to close off the week. And Foot Locker, expecting a $4.34 move plus or minus. You can see on earnings it kind of popped up, came up near that upper risk range and closed just above midline for the week. So again, nothing too exciting to write home about. Now let's focus on the indices. So if you haven't watched these videos, I like to cover the relative ETFs for the S&P, the NASDAQ 100, and the Russell 2000. So I'm showing the SPYs right here, the Qs right here, and the IWM here. Below that, you're going to have their relative futures contracts. So this is going to be what they call the ES, the NQ, and the RTY. So they're each of their respective futures contracts. So the futures contracts are going to show your overnight movements. First off, let's just note this was options expiration for the month of May. So the May options expired on Friday. So you get a lot of crazy activity. Now let's just focus on the spiders here. So we just kind of had a slow fade throughout the week. Although this is a pretty significant move, it came down to tap this lower side of the risk range. So it was expecting a $13.53 move. Again, we talked about how efficient these markets are. Tapped that lower range numerous times, tried to hold support, hold it again. And from a technical standpoint, I would call this a potential bearish flag pattern that's forming here. So this is a bearish continuation pattern. And on Friday, we broke below that range. And what I want you to note here is 390 is an important level. 385 ended up being an important level, and 380. So I'll focus on something relative to that in a second, but just from a respective standpoint, we broke below that range, came down to retest or test 380, and then they stick saved it into the end of the day to close within that range right at 390. Now, what I want to show you in addition to that is the SPY open interest. So these are the May expiring options. So from an open interest standpoint, your largest open interest relative to price action where we were, I'm going to change the color of that because that's hard to see. Let's change this to blue. So you can see 390 was important, 385 was important, and 380 was important. We just brought up those levels on the chart, and why I wanted to show you that is look at the volume. So this black line is going to be your volume for those strike prices. So this is your 390. Pardon my terrible writing. This is your 385. And this is going to be your 380. And what's crazy to see is if you go over here, this is 175,000 contracts on the 390s. You had 225,000 on the 385s and almost 300,000 on the 380 puts. So there's a lot of activity just on Friday's action. And let's just note, even on the call side, there's not a lot of call activity up here, but you can see the largest open interest on the call side, or largest volume, sorry, was on the 390 calls. And then you kind of had a drop, a scaled version of it down all the way up to 400. Now, when you talk about max pain theory in options world, they like to pin the price of the underlying at the point with which most options end up being useless. Now, so you can see we came down price-wise down to that 380 mark like we noted on the chart, and then they magically recovered this back to 390. So naturally, right at this point, all of these puts got screwed and all of these calls got screwed. This is a really stupid looking chart, but let me just say this would be your max pain for your daily activity, and I would say for the overall open interest. So is it a coincidence why we closed right at 390? I wouldn't say so. I'd say this stuff happens for a reason, and there's likely a reason why they closed it right there magically. So on the downside for the ES, a little bit wider range. So you can see the SPYs hit the low side of their range earlier on in the week, where the ES didn't tap. Well, I guess they both did, sorry. It did come down here on Thursday, but this is your overnight session that you don't see on the spiders. So they ground this higher and higher into Friday night. And truth be told, I was shorts an ES contract at that point. So they were pressing me into the upside there going into Friday morning overnight. But you can see this is what I would consider a bearish wedge pattern, which ended up failing. They broke below that range and closed back within it. So ended up okay on the trade, but this was a little tough to hold on to overnight. I'm not going to lie. NASDAQ 100, going to be very similar action. Came down to the lower risk range. Was expecting $13.33 move. A little bit different close. Obviously, they broke below here, came down, but then they closed right at the lower risk range at 288.54. So a little bit weaker. On the NQ side, again, very similar activity. You had this potential bearish wedge forming before they broke down below its risk range, which was expecting around 510-point move plus or minus, and then they closed right at the bottom side of that risk range. Russell 2000. This one was a little bit stronger. It was expecting a $7.33 move. Didn't even come down to the lower side of that range, so you could look at this as some relative strength. A lot of people look at the Russell as a leading indicator for the markets. So maybe this gets a bounce on Monday and leads us higher, or it's been beat up so much more than the other ones that it just needed a little bit more time for consolidation sideways. On the futures side, you can see similar activity. Didn't quite come down and tap the bottom side of this risk range. Came down on Friday and then bounced back to close, almost flat on the week, which would have been right around this level. So not a lot to write home about, but it's something to be aware of that the Russell did actually hold up a little bit better than the other indices. It'll be interesting to see how it plays out in the week ahead. Moving on to our Forex and bond section. I'm not going to cover any of the currencies because the dollar did break below 103. I think it's down to around 102.80, 102.90. Nothing significant. We did bring it up last week that we expected a little bit of a drop there. It'll be interesting to see if that continues on through the rest of this week. But there are some bond things that I want to go over. The first thing I want to cover is the TLT. Now, I'm starting to wonder if we're nearing a bottom on this. The weekly chart is on the left side. The daily chart is on the right. Now, what's interesting here is, again, we've talked about these trend lines here. We've got this giant, I would say a tightening wedge almost that it's been trading within, that it broke down here within the last number of weeks. But we're coming into this area of potential support. And the support is right around, what is this, 113-ish? So you can see even more clearly on the daily part of where this bounced. Now, these lines, this $2.83 was what the expected move was last week. You can see it came down kind of near the low side of that range and then came to close on the top side. So again, it couldn't break above that. These risk ranges are very important to trading because they are what the options market are expecting going into the week. Now, these are just the weekly options. If you guys are ever interested in how to find these, it's very simple, and I can show you. I'm not going to go over that right now. But back to the TLT itself. Is it nearing a bottom is what I'm kind of wondering here. I'm going to zoom in here a little bit so we can have a better image of this. Now, I'm not getting too excited about this. Yes, the RSI is moving back up like it did here, so maybe it's nearing a bottom. The MACD is still not curling back up on the weekly time frame, so again, it still has some work to be done. But the volume was decreasing on this upward week. Not anything to overanalyze here, but there is a possibility of it maybe retesting the bottom side of this trend line. And from a bullish case, and I'll get into this more with the 10-year coming up here, but in a bullish case, maybe it's forming what we call a ascending triangle. So that means it's bumping up at the same level here around this 118.50, and it's making a series of higher lows as we move up. So the idea with this pattern is if we break above that 118.50, you can potentially get a measured move up to 125.30. However, I would first want to see it break above this trend line. If we get back within this trend line, that can create more of a buying frenzy. Because as you break down, shorts pile in, longs are giving up. But as you get back above that, the shorts are covering and new longs are coming back in. So again, this could create some buying pressure to the upside. Now, if we go into, I don't have the weekly risk ranges on this one moving forward. So this is the S&P on top and a ratio of the SPY and TLT on the bottom. Similar to what we've talked about numerous times, guys, these broadening wedges that are playing out. And you can see this was prior resistance on the S&P umpteen times back in 2018, back during the COVID peak before it plunged down to the lower side. Finally broke out here. Kind of was trying to hold resistance here a number of times, and then we broke back above. So in a lot of cases, we call these an exhaustion breakout, where everybody's finally all in. You know, everybody was buying everything after COVID when they're printing $3 to $4 trillion. You know, everything was going up. It was crypto, it was NFTs, it was equities, it was housing. It didn't matter what it was. You could throw a dart at the wall and hit something that was making money, right? Now, the concern here is we've now at least retested the bottoms or the top side of this trend line, and we've closed below it on a weekly time frame. This is not a positive sign from a technical perspective, and from a support standpoint, I don't see much support until we get down to this 3,400 mark. We have a lot of people calling the bottom here thinking, there's no way we can go lower. It's impossible. Yeah, okay, whatever. From a technical standpoint, I don't like what's happening here. Maybe on a short-term basis, we could still get a bounce, yes. And then on the bottom side, this ratio of the SPY versus TLT. So this is the spiders versus the 20-plus year Treasury ETF. And I show you this because, again, it's got this similar broadening wedge. And this ratio has gotten far outside of what I would consider normal. I mean, look at where this ratio was here, even back in during the financial crisis, around 2. Now we're up above 3, and it almost tapped 3.75 up there. So this is a huge run. Now, the concern with this is there's been a huge expectation on inflation, right? So the Fed's starting to raise rates. They've barely done 75 basis points. And they haven't even started their unwinding of the balance sheet, which is supposed to start in June, I believe. So that's coming up in the next couple weeks. Now, the problem I have is as those inflation expectations start to drop and we start to near, if we're not in a recession already and we start to enter a recession, the yields will plummet. So there's going to be a huge influx into the bond market. And what's concerning about that, and I'll show you on the next chart, is we've had bonds selling off along with equities. And in most cases, bonds tend to sell off as equities move up. So money is coming out of safe havens and moving into riskier assets. Now, if that TLT does explode, this part, and the SPY drops, so if this ratio breaks back below this range, I think this could get a violent move to the downside. I hate to be the one to sit here and call a market crash, but so if TLT drives up and SPY goes down, this ratio is going to drop significantly. And the reason I wanted to bring up another chart here is, let's look at so on top, you're seeing the 10-year. This is a 20-year weekly, going back to around, what is this? 2002. So why I wanted to show you this. The 10-year rate has been climbing up all the way up to that, around 3% here, which it tapped 3.1. I can't remember what it was percentage-wise. And it's starting to pull back. Now, a slight pullback is a good thing because the tech sector does not like higher interest rates. The growth stocks like lower interest rates. It creates more liquidity for the markets and growth stocks. However, what I wanted you to see here is if the 10-year rises, so let's go back to 2008. The 10-year kind of held this level, but you can see as the interest rates dropped or as yields plummeted, you had this huge upswing in the volatility. So this purple line is the volatility index. So again, when I say there's the potential for yields to plummet, that could create even more volatility. Again, back here during COVID, the 10-year yield dropped and the volatility index spiked up. Again, this creates a huge selling pressure on the equity markets. My concern here is if the 10-year decides to do this, what's going to happen to volatility? Are we going to see a spike up in volatility here? It's something that we need to be aware of because just like back in 2007, 2008, the VIX was making a series of higher lows before it finally kind of took off. So you can see it broke back up around this 20 range. 20 is always a very significant number in the VIX, and it kind of consolidated here. So it was winding up for a bigger move before it kind of exploded up. What are we seeing here? Even back to, let's say, 2018, you've had a series of higher lows on the volatility index. Now, we don't know how long this could play out. Is this going to play out just in the short term here, or do we have a lot longer time frame to consolidate here before it potentially busts out to the upside again? I think we're in a different scenario than we were in the financial crisis. This inflation problem is a huge mess, and the Fed is stuck between a rock and a hard place. And I hate to be very pessimistic and negative, but so many people are calling for the bottom here. I'm not saying we can't get a nice bounce moving forward, but there always is that potential for a bigger crash. When you start to see the Dow down 1,000-point days, that's something to be aware of. And the VIX has not been responding so much to some of these massive moves, and I'm not quite sure why. The only thing I can assume is there's still a sense of relative complacency in the market. You've got a lot of retail people still trying to buy the dip. And I'm just afraid that's going to be a very bad move moving forward. So from a bond standpoint, pay attention to the yields, pay attention to the velocity of those yields if they do start to plummet, because if they do, I would expect some volatility to be moving into the markets even more so than it has been. All right, moving on to some forward-looking technicals. The first thing I want to note from just a general view is right now, we'll start with the spiders here, we are making a series of lower highs and lower lows. So until that trend changes, we are in a downward momentum market. Now, here's a couple scenarios. If, for example, we come back up, retest this high, pull back, make a higher low, then I would be more inclined to believe that the trend is changing a little bit. The other possibility is we come up to this high, maybe we base for a little bit before we get another push higher to break above that. That would buck the trend in the near term. Or there's always a scenario where we blast right through it, possibly come back down and retest and move up. So generally speaking, we need to change the trend before I am going to be bullish from a, even a medium time frame perspective. Looking forward, SPY is pricing in a $12.70 move, plus or minus, which takes us up to around this 402, 403. This was a big level. I remember from last week, we were knocking our heads on this constantly. So that's going to be a big point of resistance. And the low side of the range down to around 376.86. So again, we've been focusing on these risk ranges. They're very important from a level perspective and a trading perspective. Now there is only one little potential bullish divergence happening here on the RSI. The MACD is not exciting me at all, and volume wise, there's really nothing to say we've capitulated or anything. So moving forward, the SPY has some work to do, and right now we just have to kind of play the ranges. The QQQs, very similar to the spiders. Again, lower highs, lower lows. The trend hasn't changed yet. Pricing in a $12.31 move plus or minus, which takes you up to around 300, 301, which again is a very important level. As we've seen, this was prior resistance, which is around right where we're sitting, right? Well, we're a little bit lower actually, but that's going to be a big level. That was prior resistance, turned support, and now we've broken back below that over here. So that could be some major resistance. It wouldn't surprise me if the bulls made another run at 300. It's kind of a big level. Otherwise, there's not a lot to get too excited about here. There is a gap down here around 274.65, which coincidentally lines up with the low side of this risk range. So we kind of have to see how this week plays out. Lately, the week has been playing out more upside, beginning of the week, Monday, Tuesday, Wednesday, and then we kind of go down Thursday, Friday. So we just kind of have to see how that trend continues on. Now let's talk about the IWM, the Russell 2000 ETF. Now, if you notice what we were just talking about, we had higher lows or lower highs and lower lows. The difference here is the IWM made a low, but it made a higher low now. So is this index telling us something different? A lot of people like to use the Russell as a leading indicator in this market. So how this one responds may give us some hints as to what this market wants to do in the near term. So we got to keep an eye on this one going into next week and how it reacts. So far, it's pricing in a $7.21 move, which takes us up to around this 183.50 mark, and the low side down to 168.78. I'm still not too excited about this. Again, it wouldn't surprise me if we came back to retest this 190 level at some point. If we got a nice squeeze out of it, I would look for a nice short opportunity around there if that were to happen. Maybe we're flagging out here for the next leg lower. That's always possible. And we still have a lot of kind of empty space down here and gaps that could be filled. So this isn't something where I would get involved at this point. We like to wait till we hit the top side of this range or some of these levels before we either enter a short or we go down, maybe fill one of these gaps for a potential long opportunity. As I've said before, I like to kind of wait the week out, see how things play out in the first couple days, and then kind of move forward with some trade opportunities. Looking at the relative VIX products. Now, noting on these SPYs how we were making lower lows, the VIX has been making a series of lower highs. Now, does that necessarily mean anything yet? Because what could be happening here is when things expand, they go into contraction mode. So we expanded here up in the VIX, and now we wonder if it's contracting for another move. So that doesn't mean we're out of the clear yet. This could be a potential head and shoulders top somehow. I mean, I'm less convinced of that, but you do have, there's not a lot of gaps here to be filled. So again, this is consolidating potentially for a move higher. We have to be aware of that. Now, if we were to get below, let's say 26, then I would say the trend is changing in the overall indexes. I would expect the S&P to be moving up a little bit higher and maybe breaking some of those prior recent highs so we can break that trend, right? So keeping an eye on the VIX here, there's really nothing. It's kind of very neutral here from a MACD and an RSI perspective. And remember, the VIX is relative to the S&P itself. The VXN, which is the middle one here, is similar natured. So it's making a series of lower highs and higher lows. So expansion leads to contraction. Are we just basing for another move higher? And in both of these cases, there is always the potential, as I brought it before, for a cup and handle or a bullish flag pattern playing out here. And just like I said over here, you've got similar activity. with this dip down here and consolidation before potentially a rip higher. Nothing too much different with the RVX. So this is the Russell Volatility Index. Again, lower highs, higher lows, maybe just basing for its next move higher. So let's move on to the top 10 S&P holdings. We've been through this before. If you don't know them, you can look them up. Last week, I was testing out the risk ranges on this. So again, I found the risk range for each individual stock, and then I multiplied it by its relative percentage weighting in the index. Now, it's really interesting to see how this played out, because if we go to a smaller time frame here, you can see that clearly this had some importance, right? It was tapping the bottom side of this risk range. So this index that I created was pricing in a $12.85 move plus or minus, and it kept bumping the bottom side of this. Now, I was pretty bearish going into Friday, just given the fact that we were making, we were bouncing off this lower range here, and we were making lower highs. So that's, to me, a bearish pattern playing out. And you can see we finally broke below that. But again, they ramped this back up to close to probably pin a lot of options. And again, this was very similar action to the SPY, because those top 10 holdings are 27-ish% weightings of the entire index itself. So it's not surprising that this looks very similar to the spider action itself. Now, from a larger time perspective on the left side here, this is a weekly time frame. I've noted this trend line. That was our prior resistance that it broke out of here back during the COVID low. And we came down finally for the last 2 weeks and have retested that, and they just closed above it, as you can see. So I'm thinking this is basing potentially. Now, if we can break those, again, if we can break the trend and make some new highs here, then I would be more on the side of the bullish perspective. But my other concern here is if I turn the drawings off and we make a trend line here, there's potential for what, and I know I bring this pattern up all the time because all of these charts are going to be very similar in nature. You have this potential head and shoulders. Now, this one didn't come back down and retest this to form a perfect left shoulder. But in the case of what was happening, there was a lot more momentum in these stocks. So this one was holding up a lot more than most of the other indexes. So these were getting a lot more momentum, a lot more activity from a trading and a so-called investing perspective, right? But if we focus on the price target for something of this nature, this takes us down to around this 186, which coincidentally lines up with the previous COVID level, right? This was before COVID, and this was where we dropped back down to this low side of this range and we broke back up. So it wouldn't surprise me one bit if we drop down into this level, and I would expect if we break this trend line that we will come down there. There's not a lot of support left down here. There is some right here around, what is this, 220-ish, which maybe we're already using that up right now. But below that, you've got a lot of dead space, airspace here that this could drop down at least to this level. But even so, I wouldn't underestimate the possibility of coming back down to here. I'm not going to get into the PE ratios and all this stuff, but people need to be aware of where we were and where we've gone and where we could potentially go back to. If you look at it from the cocaine pump into the economy during the COVID plunge when they dumped in those trillions of dollars, if all of that drug use is used up now, what's left to keep driving us higher, right? We need some catalyst. We need some positive force to continue this momentum to the upside. Now, just for a little perspective, I want to show you the chart of the ARK investment fund. So this is Kathy Wood's staple ETF that she's been running. And I think this is a forward indicator of the market's activity and where it's likely heading. And again, we've talked about this broadening wedge. This is a weekly chart, mind you, that it broke out of at some point. It ran up. This is your euphoric run up. This is your everything's going back to normal. Dip down here. People thinking we're going to run back up. But again, once we fall back within this channel, after this big exhaustion breakout, it's lights out. You can see ever since then, it's just been a disaster. If you tried to buy the dip at 100, now we're down to the 40s, so you've lost over 50, 60% of your value. And I would imagine, looking at the volume here, how many people have been trying to buy the dip here and catch the bottom. I don't think it's there yet. I think this is a leading indicator for where this market is heading. And I think a lot of those indexes, a lot of those sectors of the market are going to fall prey to this exact same pattern. Some are just later than others to get to that point. Now, if you're an ARK follower, you can see we've kind of hit this other potential support line, but I don't see any other support if we break below that down to around this, I don't know what this is, 22-ish level. So again, you need to be mindful that, it can't go lower. If I buy at 40, well, if it goes down to 20, you just lost another 50%. So keep that in mind when you're trying to catch the bottom or catch the dip in some of these things. And since we covered a lot of Walmart, Target, retail from last week, and once we go over forward-looking earnings, we have a lot of retail coming up again. So this is a weekly chart of the XRT, the retail ETF. Again, very similar nature to what I just showed you. This broadening wedge that we broke out of up here, this exhaustion breakout that ends up failing ultimately, and it's just been a bloodbath ever since. Now, I would also feel like this big weekly candle we just had was attributed to Walmart and Target's earnings. And unfortunately, I just don't see any support until we at least get down to this 50 level. If you guys have followed my emails and stuff over the last number of months, I've noted this one out for quite some time. But 50 is going to be your first potential support area. Even so, I would consider this maybe the next point of interest down here around 37. And you can kind of see why I'm focusing on that level, because you've got a number of bounces here. So that's going to be another major level. It's always a crapshoot if we bounce at the top side where it was prior resistance turn support. This was our retest as support and we come back up. It doesn't necessarily mean it's going to bounce here. Just kind of like you saw in RK, it came back down to that lower side of support. So, and again, I would assume at some point it's going to retest this trend line. I have no desire to want to be long anything retail right now after the number of things that we've also discussed. And just because everybody loves to talk about these, Apple is your top holding of the S&P 500. I believe, don't quote me on this, it's around 6% weighting of the entire index itself. And what I wanted to show you guys is everybody's trying to buy the dip on Apple thinking this will never go down, right? Well, that doesn't necessarily stand true. This was hyped up just like everything else during the COVID drop. And again, similar to that SPY top 10 holdings index, you've got a potential trend line here that I would assume at some point it's going to come down and retest this. And from a larger time frame, this is the weekly, mind you, on the left side, there is a potential head and shoulders here. We've beaten this pattern to death, but it's very relevant, especially in the overall market trends. Now, if you were to measure this one out from the peak to the neckline, this takes you down initially to around this 116 mark, which you do have a little confluence of resistance or prior resistance or activity in here. So, and it kind of lines up nicely with this trend line, right? So that could be a potential bounce area. Ultimately, I would still at some point believe, and I know you guys aren't going to like me for this, that I think we're going to come back down and retest the COVID high or the pre-COVID high right here around 81. Somewhere around this trend line, connecting these bottoms here. So anywhere in between this 80 and 90 range, I think eventually we'll make it down there. Now, I'm not saying that's going to happen in the next month or the next week. There will be buying opportunities in here. If we go over to the daily chart here, for the week, they are pricing in a $6.75 move plus or minus, which takes you up to around 144 or down to around 130.67. And this stock is very good at playing within these ranges, just given the activity. But another person I follow, the Wall Street Maverick, he brings up a lot of option stuff in the latter half of his analysis videos. And he's saying there's just a lack of call activity in the overall market. And during these big drive ups since the COVID low, there was a lot of calls being bought. And that, again, it goes back to the dealer hedging and the dynamic hedging that happens. The more calls you have, they create gamma squeezes. I'm sure you heard all about that with GMC and GME and AMC stocks over, past when they were squeezing up higher. So until we see some more call activity, we're back to the lower highs, lower highs, lower highs, lower lows, lower lows, lower lows, lower lows. The trend hasn't changed, guys. So trying to catch a bottom is it's like a coin toss. I wish you the best, but until we see something change where we're retesting this high, for example, consolidating, moving up, or retesting and pulling down, maybe we form an inverted head and shoulders before we take a rip higher. We just need to see this trend change before we can change our larger perspective on the markets. And the last thing I want to cover is Tesla, because everybody loves to follow Tesla. The larger perspective, I'm going to say this again, we have a potential head and shoulders playing out, right? The volume isn't very big here, but maybe there's still a lot of people holding onto the bag thinking Tesla's not going to drop. So if that selling pressure does exacerbate or gets higher, that can definitely drive this price higher. Now, if we, and I want to give you guys perspective on this, if we measure the move here from peak to the neckline, that takes us back down to around this 156, which lines up with some prior support or resistance turn support here. Now, you might think I'm crazy in saying that. I think currently the PE ratio is around 104. If we were to drop down to somewhere in this level, the PE ratio would be around 25. So to me, it's not that crazy. If you can prove to me why there's a positive catalyst that Tesla is going to continue to uphold its current PE ratio or go above it, then I would be more apt to saying this might be a void pattern. Or maybe we come down to just retest this low because you've got some prior support here too. But I'm just very skeptical. If we go over to the daily time frame on the right side, for next week, it's pricing in a $69.32 move plus or minus, which maybe we can get back up and retest this potential neckline. If the bulls can take this back, then I would say there's some more potential pressure that we can get back up further up higher. I've seen Tesla do that, so I'm not going to rule that out. But again, just similar to the other things we've talked about, lower highs, lower highs, lower lows, lower lows, lower lows. Nothing's changed here. Moving on until the trend changes, guys. All right, I'm going to assume you guys have had enough of my voice and enough of my charts. Let's look at the earnings coming up. We have a lot of retail, guys. I told you we were heavy on this side of it, so this could be a big pushing catalyst for this market this week. Monday, we have Zoom, Advanced Auto Parts. Before the open Tuesday, we have Best Buy, AutoZone, Abercrombie Fitch, Ralph Lauren. Wednesday, we have Dick's Sporting Goods before the open. And after the bell, we have the big old NVIDIA, Snowflake, Splunk, Williams-Sonoma. Thursday, Dollar Tree, Dollar General, Jack in the Box. Thursday after the close, Costco, Zscaler, Autodesk, Ulta, Dell, Workday. So again, pretty heavy week from an earnings perspective. So I've put all the risk ranges on here for you guys if you care to look at them. I'm not going to chart all them for you. You can do some of the homework yourself. Moving on to the economic calendar for the week ahead. Monday, we have nothing. Tuesday, global U.S. manufacturing PMI, U.S. services PMI, new home sales. Wednesday, durable goods, core capital equipment orders, FOMC minutes. That one can always be a nice algo pusher, especially when the Fed's in such big main focus right now. Thursday, initial jobless claims, continuing claims, real gross domestic product revision, real final sales to domestic purchasers revision. Some of these I don't care, don't know. Real gross domestic income, blah, blah. Pending home sales. And then on Friday, we have a heavy week with the PCE inflation, core PCE, PCE inflation. And these are the Fed's favorite indicators of inflation. So these will be in focus at the end of the week. Real disposable income, consumer spending, nominal personal income, nominal consumer spending, advanced trading goods, University of Michigan Consumer Sentiment Index, and 5-year inflation expectations. So pretty heavy week from the earnings side as well as the economic side, especially going into the end of the week. And let's talk about conclusions with everything we've talked about. My conclusions would be we are very oversold. So a bounce is always a big possibility, especially with a short squeeze. They're likely going to be short-lived unless we get some positive catalysts and some of these things out of the way, you know, inflation-wise, earnings-wise, consumer-wise. So for me, until then, if you're an investor, I think you have to be patient. There's going to be better opportunities to come. If you're a trader, this is a great environment, but you have to be mindful of your levels and your risk management. So keeping the longs tight on the bounce plays if you're a long type of trader. Wait for the short squeeze rallies to short into if you like to trade short. And I would definitely keep an eye on the bond market. This will be a telltale of where these markets are heading. Keep an eye on that Russell 2000. If it starts to lead us higher, that could be a good catalyst for the overall markets. That is all I have for you guys. I truly appreciate you watching and listening. If you made it this far, bravo, because this ended up being a lot longer than I anticipated. I tried to be efficient, and it still took me this long. So please like, share this, subscribe, send it to your friends, your family. Let me know if you got feedback, comments. I'm open to anything you guys have to say and ideas. Thank you again, and till next time.